Hello, my name is Gary Squire, and I'll be your guide through this short video. I want to thank you for your interest in this important topic, creating guaranteed lifetime income using fewer assets. We hope you find value in it. Make sure you check out our other videos as well. Now, important note, this video is designed to help create awareness of the concept being shown. Your situation and everyone's situation is unique and requires further discussion and review. Feel free to contact us about your unique situation. Now, this strategy will help answer three critical questions about your retirement income planning. Number one, will your income be predictable, or will there be ups and downs in the amount of income you receive year over year? Number two, will you or your spouse outlive your income? Longevity must be addressed in retirement income planning. And number three, are you using the least amount of assets to create your desired income level? So let's get started. Your retirement income plan, why is it important for you? Fuel. Income is the fuel that runs your retirement. Will you have enough fuel and the proper fuel? Shortage. If your income falls short, what do? Go back to work? Change your lifestyle? Will you face these very tough decisions? Longevity. Live to 85 or 105? Nobody knows. Will you outlive your assets? Overpaying. Are you using the least amount of assets to meet your income needs? Both lives. Will your surviving spouse have enough income? Solve first. Have you truly solved your income problem? Let's look at a real-world example. All right, so the current goal and current situation. Maintain your desired lifestyle throughout retirement using the least amount of your assets. I think we can all get behind that as a goal. So in this example, the Smiths are 5 years from retirement, and they're going to be they're going to supplement their retirement with $30,000 of annual income. So the withdrawal strategy they're going to use is the one that's most commonly used today. And if you're not sure of your strategy, chances are you're defaulted into this strategy. It's called the 4% withdrawal. Now, we're not going to look at inflation or incorporate taxes in this. We're going to keep it very simple. So using simple math, if I need $30,000 and I'm taking 4% year over year, well, how much dedicated assets do I need to maintain? The answer is $750,000. So this is what we call a market-based strategy. And 99% of the strategies out there are market-based. That means is that it's dependent on what the market does or doesn't do. Market can move in any three directions. It could be up, flat, or down. So how does the market-based option react to the different market conditions? That's what we want to look at. So if the markets are up, your account is up. That's a good thing. That also means that over time, in a bull market, your withdrawal percentage technically could go down. Now, in a flat market, you're still taking out the $30,000 of annual income, right? You got to keep the lights on, put food on the table. So that means your account is still going to be drawn down. That also means that over time, it could raise your withdrawal percentage, which means you're going to faster deplete your assets. And if the markets are down, well, that's a given, right? That means your account is going to be down and your withdrawal percentage is going to go up over time. An example would be if I'm down 10%, which I'll be at 648,000. That means in order to get 30,000, I need to draw a 4.6%. And if I'm down 30%, like what some of us were in COVID hit, that means I'm pulling a 6% withdrawal percentage. And you can kind of see how that really can impact our longevity and getting through retirement with that asset. Now, the Morningstar report recently ran simulations in the current economic climate, and what they found is that the probability of success of a 4% withdrawal approach is 50%. 50%, and that's because of the low interest rate and the volatility going on. Now, 50% is not acceptable. 90% is considered the industry's acceptable standard. And Morningstar ran those simulations to see, well, what would it be to get that 90% in the current economic climate? And what it found that it would be 2.8%. Now, 2.8%, how much is going to be dedicated to get that 30,000? Well, the number goes up, 1,075,000. So let's look at an alternate option that addresses these obvious shortcomings of this strategy. Again, we're going to have the same goal and current situation. So in this strategy, we're going to use a guaranteed retirement pension. If you notice, there's no bucket behind that because this is a pension. It is a guaranteed income stream. So we're not depleting an asset. It also tells us that this is not a market-based strategy. It's not dependent on what the market does or doesn't do. Up, flat, down, it's irrelevant. The income continues year over year. And if we look at the probability of success then, getting through our retirement, it's what? It's obviously 100%. Now, the million-dollar question here, though, is, well, how many assets need to be dedicated for this kind of approach, this guaranteed retirement pension? Well, we ran the numbers to get $30,000 in this example. It required $388,000. So let's recap the benefits and the outcomes. Predictability. This strategy, there is no peaks or valleys in your income. Your desired income comes every year. Longevity, 85 or 105, it doesn't matter. This is a lifetime income, and it also could be set up on your spouse as well. Efficiency, the numbers don't lie. $388,000 is a lot less. It's actually $362,000 less than their original option, which was a 4% strategy that took $750,000. So the Smiths can take this additional asset and do whatever they like with it. All right, creating guaranteed lifetime income using fewer assets. To learn more about this option and if it may meet your needs, simply reach out to us by using the Request More Information form. Thanks for watching.